In the history of Wall Street, Bear Stearns was known as a firm that survived the Great Depression, multiple recessions, and market crashes. But it ultimately met its fate in a matter of days during the 2008 financial crisis. At its peak, Bear Stearns was a powerhouse of investment banking, known for its aggressive culture, high rewards, and a swagger that came from decades of success. Its collapse became a stark symbol of the dangers of excessive leverage, overconfidence, and a blind faith in rising markets. In this video, we will see the full story of Bear Stearns, from its humble beginnings to its explosive growth, to the catastrophic collapse that signaled the start of a global financial crisis. The birth and rise of Bear Stearns. Bear Stearns was founded in 1923 with just $500,000 in capital by three men: Joseph Bear, Robert Stearns, and Harold Mayer. Initially, it was a bond trading firm based in New York. It survived the 1929 crash and the Great Depression. This survival became a proud part of the firm. During the post-World War II boom, Bear Stearns began to grow aggressively. The 1950s and 60s were golden years for financial markets, and the firm capitalized by expanding into brokerage services and underwriting. But it was in the 1980s, under the leadership of Alan Ace Greenberg, that Bear Stearns truly transformed into a Wall Street titan. Greenberg was dominating Wall Street. He favored sharp thinkers over PhD holders. His preference was called PSD, which meant people who are poor, smart, and with a deep desire to be rich. This meritocratic and competitive culture made Bear Stearns one of the most aggressive and entrepreneurial banks on Wall Street. In the 1980s and 90s, Bear Stearns capitalized on the growing complexity of financial markets. The firm delved into structured finance, mortgage-backed securities, and derivatives. By the early 2000s, it was one of the largest players in the securitization of home loans, including the now infamous subprime mortgages. James Cain took over as CEO in 1993 and later became chairman. He was a former traveling bridge player and bond salesman. He turned Bear Stearns into an even more aggressive profit machine. Under Cain, the firm's revenue and stock price soared. But Cain's leadership style raised eyebrows. Known for his temper and arrogance, Cain was often disconnected from day-to-day operations. He reportedly spent long weekends playing bridge, smoking weed, and enjoying the perks of Wall Street wealth while his lieutenants took charge of complex risk management decisions. In 2006, when the market was already flashing signs of stress, Cain missed an emergency meeting because he was unreachable playing in a bridge tournament with no phone access. By the mid-2000s, Bear Stearns had become one of the most aggressive participants in the U.S. housing boom. It wasn't just buying and selling mortgages. It owned mortgage originators like the EMC Mortgage Corporation and had direct exposure to the riskiest loans in the market. It packaged mortgages into complex financial products like collateralized debt obligations and mortgage-backed securities. These were sold to investors with AAA ratings from credit agencies, giving the illusion of safety. The firm also created hedge funds that leveraged themselves to buy those products, betting that the housing market would keep rising. When housing prices were going up, Bear Stearns was minting money. The firm posted record profits in 2005 and 2006. James Cain personally became a billionaire on paper during this time. But there was a hidden fragility beneath the surface. Bear Stearns operated with incredibly high leverage, sometimes 33-to-1. That means for every $1 of its own money, it borrowed $33. This left no room for error. A slight decline in asset value could wipe out its capital. Yet, the firm kept pushing its boundaries. By 2006, cracks had begun forming in the subprime mortgage market. Default rates were rising, particularly among borrowers with poor credit histories who had been lured into risky adjustable-rate mortgages. But Wall Street, including Bear Stearns, dismissed these as isolated events. They believed housing prices had never declined nationwide. In early 2007, two hedge funds managed by Bear Stearns' high-grade structured credit strategies enhanced leverage fund and its sibling fund began to see impact. These funds had borrowed massively to bet on mortgage-backed securities. When the value of those securities began to drop, the fund's positions turned toxic. By June 2007, creditors started demanding their money back. The funds were forced to sell assets to raise cash, but no one wanted to buy. A liquidity crisis had begun. In a matter of weeks, both funds collapsed. One lost over 90% of its value. Bear Stearns was forced to inject $1.6 billion of its own money into the funds in a desperate attempt to save the damage. This was the first major shock. It rattled investors and drew the attention of regulators and Wall Street insiders. But instead of fully confronting the scale of the risk, Bear Stearns doubled down. James Cain, still CEO at the time, was reported to be playing bridge while the firm scrambled to keep the hedge funds afloat. Behind closed doors, senior executives were in chaos. Cain eventually removed himself from day-to-day operations, and Alan Schwartz was appointed CEO in January 2008. Cain remained chairman but was sidelined. Still, the damage had been done. Even though Bear Stearns was technically solvent in early 2008, trust is the oxygen of Wall Street, and Bear was running out of it fast. The firm's balance sheet showed nearly $400 billion in assets, but only about $11 billion in capital, a razor-thin cushion. Worse, many of those assets were hard to value, like mortgage securities and derivatives. Investors didn't know what Bear was truly holding, and fear began to spread. Rumors of insolvency swirled in March 2008. Counterparties started pulling their money. Clients stopped doing business with Bear. In a span of just 48 hours, the firm went from a functioning investment bank to a crippled institution with no access to cash. On Friday, March 14, 2008, the Federal Reserve stepped in with an unprecedented move: a short-term $12.9 billion loan to keep Bear alive for the weekend. That weekend, emergency meetings took place in Manhattan. The Fed, the Treasury Department, and top Wall Street executives tried to craft a solution to avoid a catastrophic collapse. No one wanted to buy Bear Stearns. The liabilities were too opaque, and the risks were enormous. Finally, JP Chase, with the Fed's guarantee, agreed to purchase Bear Stearns. The JP Morgan acquisition of Bear Stearns was controversial from the start. Critics accused the Fed of bailing out Wall Street recklessness with taxpayer guarantees. Supporters said it was necessary to prevent a full-blown financial catastrophe. JP Morgan initially offered to buy Bear Stearns at $2 per share, valuing the entire company at around $236 million. It was less than the value of Bear's headquarters building in Manhattan, which was around $1 billion. In this meeting, one Bear executive reportedly screamed, "You've just sold us out for the price of a cup of coffee." Shareholders were furious. In a rare move, JP Morgan was forced to raise the offer to $10 per share. It was still a 93% discount from the stock's peak. The Federal Reserve, in an extraordinary intervention, agreed to back $29 billion of Bear Stearns' toxic assets just to make the deal happen. With this move, Bear Stearns, an 85-year-old institution, was gone. Employees were informed over the intercom that JP Morgan is now your new employer. You might be wondering, what happened to the people involved? James Cain, who was once worth over $1 billion on paper, lost nearly everything. He sold his remaining Bear stock for just $61 million. He faced intense criticism in the press and from Congress, accused of reckless leadership and being asleep at the wheel. Cain refused to take responsibility for the firm's failures and accused the Fed. Alan Schwartz, who had only been CEO for a few months, remained on during the transition to JP Morgan, but soon left Wall Street. He later founded an advisory firm and made occasional media appearances, often defending his tenure. Ace Greenberg, the old-school trader and longtime Bear icon, wrote a book after the collapse titled The Rise and Fall of Bear Stearns, attempting to set the record straight. He died in 2014 and was still loyal to the firm he helped build. The fall of Bear Stearns was more than just the demise of one firm. It was the first domino in what would become the 2008 global financial crisis. When Bear went under in March 2008, it sent shockwaves across financial markets. But at the time, many believed Bear's failure was unique, a result of poor risk management and excessive exposure to subprime mortgages. They were wrong. Just 6 months later, Lehman Brothers collapsed, triggering a full-blown financial panic. If you thought Bear Stearns was shocking, wait till you see what happened with Lehman Brothers. What exactly happened with the Lehman Brothers from start to end is covered in this video. Overall, the full-blown financial crisis was much severe, but it all began with Bear Stearns. We have covered everything about the 2008 crisis. If you want to learn more about it, then subscribe and check out this playlist.